Hey everybody, thanks for tuning in for another episode of the YVR REMO Show. This will be a good one. We're going to touch on something that's it's very topical. It's become more and more popular over the last probably 3-4 years, I'd say, since we've seen a massive uptick in property values locally here, anyways, in Greater Vancouver and the Lower Mainland. Multi-generational properties, multi-generational purchases, again, becoming more and more popular, especially I'd say what I've personally noticed over the last 12 to 24 months. So we're going to dig into, why is this happening? What are the most common situations where we've found people have made sense of the situation? Financing can be challenging. It can, need some creativity. So we're going to talk about some ins and outs there. Title and ownership, making sure that you're protected. And then just lastly, best practices and suggestions for anyone that thinks that this might be a good idea or wants to dig into it further. So I'll Tyler is with me here today, and Dean's going to be jumping on in a little bit, but I'll let Tyler kick it off just with why is this happening, and kind of what are we seeing, and maybe actually before we dig into that, maybe let's just talk about what multi-generational purchases and real estate looks like.
Yeah, absolutely. I mean, when we say multi-generational, we're talking about people of the same family typically purchasing a home together. So whether that's, I mean, the most common one is parents and kids, right? So um, it's multiple generations, just to really break it down, multiple generations buying a property to live in and occupy together. And I'm sure we'll all touch on it. We all have personal experience with this, with real estate that we've worked on in the last few years with our own families. And the big reason as to why, just the main driver and reason is affordability. And really, if I think about affordability, the affordability in the detached housing space, right? So people want to buy that detached home with a yard, with a pool, whatever you want. It for a lot of borrowers, a lot of young buyers, especially, that marketplace is just getting further and further out to reach. So how do you do it? If you're unable to save for a down payment on a home, Derek mentioned we're lower mainland of Vancouver, a detached property, that's going to run you seven figures at least, right? A million two to all the way to 3.5, 4 million, depending on how big of a property you want. For a young buyer, a young family to try and make that purchase, saving for down payment is quite a bit, right? And we help a lot of families, a lot of young buyers with gifted down payment, but usually for their first purchase, it's not going to necessarily be a detached house in this part of the world unless they're getting a substantial gift or have, incredible savings. So we see a lot of families just combining forces. And what it typically looks like is parents who've been in their home for a number of years, maybe approaching retirement, and kids who are both working, maybe in a relationship, have young children, combining forces where the parent may sell their home, take their equity that they have, complete the purchase with their kids on the mortgage and on title as well, qualifying for the mortgage, and then however they chop it up in terms of who's making the mortgage payments, etc. We'll dive into that a little bit deeper, but this podcast topic really came up because we're getting more and more of these calls all the time, and talked about personal experience. My own family, my sister and my mom purchased a home together. I helped with the mortgage, and we set it up for this exact reason, right? They wanted to buy this beautiful home out on the island on an acre of land. They couldn't do it separately, so they've done it together. Even if I think like secondary reasons, childcare costs, all those expenses are going up. You buy with parents, maybe that you've just worked in some built-in babysitters.
There's a good tip. I'm sure the parents will love that one.
Yeah, definitely.
Yeah, but like Tyler hit the nail on the head there. Like affordability is hands down the biggest driver for this. I'd say if most people could afford to do their things separately and get that beautiful property, they would probably do it on their own. Everyone's situation is different, but I think that's the biggest driver, hands down. Number two, getting into that dream type property, right? And don't get me wrong, that's not for everybody. Sometimes it's just like, I want to get into a detached home because I have a growing family or what have you. But we've seen a lot of people over the years too that they want the beautiful property and the acreage and what have you, and it just doesn't make sense financially on their own. And then just sharing property costs, like life expense has gone up significantly, but at the same time, you get into these more expensive homes, and property taxes on the average detached home is, $450 a month now. Plus you're getting into a big hydro bill and Fortis and what have you, right? So sharing property costs at the same time can have a pretty big impact. You typically don't see that property taxes increase dollar for dollar. Like if you go from $1 million home to a $2 million home, you're typically not seeing property taxes double. So you do kind of get ahead of the game a little bit in that sense. But to speak to my own situation, I bought a property a year ago with my family. It's an acreage with a couple homes on it. And that all actually came up because my wife and I were thinking about selling our house, and we were going to buy some land, and for what we could qualify for, like we were going to get an acre with a smaller older house on it, and it was going to cost a lot of money, and we couldn't really stomach doing that. And at the same time, we just lucked out. My parents were moving back from Kelowna, and my brother as well, and the situation, it all made sense, and we found a property that worked for us. And again, I think a lot of people go into these situations with kind of a hope and a goal of making it work, and sometimes you just don't find the right property. Like that was our experience. Is we looked at quite a few homes, and we had vision, and now you have 3, 4, 5, 6 different people trying to align and decide on one property, and it needs to work for everyone, right? So I guess I would just kind of warn everyone that if you go into this with a hope of making it happen and it doesn't happen, that's okay. I'd say it's very common, because a lot of times you're not going to find the perfect property, and you got to move on and make it work, and you end up buying something else that's a little bit off path. But yeah, anyhow, Tyler touched on this as well, but the most common situation is like the parents of the relationship downsizing, right? Maybe these are parents that have a $1.5 million home, right? Paid off or close to paid off, and they're looking at retirement. And, that's a massive chunk of money if they were to sell and even put half of that into investments, right? And the other half could now becomes a pretty monster down payment on a property. And then if the kids in the relationship are, maybe don't have a property yet, or they're selling a townhouse where they have 300,000-400,000 of equity, now you got a good sized down payment, right? And to get into, say, a $2 million home, well, yeah, sure, you're taking on a big mortgage, but that might be very affordable for the kids in the relationship, right? But they just don't have the ability to get into that property because they don't have the down payment or they don't qualify. Right. So I'd say that's the most common situation, hands down. I haven't seen a ton of like siblings doing this together. I think, again, because you're always battling that substantial down payment needed to really make sense of it, right?
Well, right, exactly, right. Like we help borrowers all the time where it's the mortgage they can handle, right? Like maybe they've two incomes are qualifying for $950,000, even $1 million of mortgage money. Which, believe it or not, if you think that's crazy and you're listening, like that's pretty common and typical for anybody trying to buy a detached property in the Lower Mainland. But if they've only got 200-300K for down payment, that might mean the purchase price that they're looking for is 1.1 to 1.2, and maybe that doesn't get them anywhere near where they want to live, A, or B, the size of the home that they need. So again, it's all kind of goes back to affordability, and the biggest thing is just the downstroke, that down payment piece. But maybe we'll move into like structure, and I would say that the most important thing is to, I don't even know if I'm saying this right, but you have the uncomfortable conversations first, right? You need to make sure that everybody's on the same page, and there's sort of a clear exit strategy for everybody. I mean, everyone's going in with the best intentions. We're going to live here, for the rest of our lives. But especially when you have young families in the mix, life can change pretty quickly over 2, 3, 4 years, especially if kids start coming into the mix. So talking to good legal professionals and even accountants, for that matter, is paramount. Talking to good mortgage brokers, people that are going to be able to help you structure that, is obviously paramount as well. I won't dive too much into estate planning, but especially imagine your scenario, Derek. You bought with your parents. Sounds like you've got you're a brother, but if he wasn't involved in any of this, if we're thinking way down the road in terms of estate planning, when your parents pass on, how does that affect the inheritance? How does that affect the will? So there's a lot of other things that you need to keep in mind. It's not just, before you just rush into this and you put your down payment and your mortgage together and away we go. You really want to make sure you're kind of looking at all angles, just to make sure everybody's covered and everybody's, happy and also protected. And like I said, so I mentioned you kind of want to have the uncomfortable conversations first, just so it's all mapped out as best as you can before you enter into something like this. So, I don't know if you guys have anything else about ownership structure you want to touch on, and maybe we can kind of blend that into financing.
Yeah, I mean, just like you bring up a really good point, which a lot of people wouldn't think about. But, like my example or anyone's example, but, if the parents are buying a property with their son, but there's a daughter involved as well that's, going to get 50% of the estate eventually. Well, whenever that comes to fruition and that actually happens, like, it's going to be on the sibling that owns that real estate with the parents to all of a sudden come up with a big chunk of money to give to the sister, which most people don't have a ton of money sitting in their bank account. So it's like, you could end up being 50 years old and you have to come up with $1 million to give to your sister, which means you're now taking on $1 million mortgage when you might be nearing retirement, right? So, I think having, like, I won't go too much further on that, but even timelines, right? And that we talk about this with everybody. If you're buying with someone else, like, even, a business partner or what have you, like, if one person's going into it with the mindset of like, this is a forever property for me, and like, I want to get this thing paid off and I want to give it to my kids, and the other person's going like, no, this is a 3-year plan, that's a shitty conversation in 3 years, right? Because someone's not going to get their way and someone else has to come up with money, or there's costs involved, right? So yeah, I mean, it's a joke on my place, but no one's allowed to get a divorce because that would throw us all for a loop. um, but yeah, and even, there's a lot of things that you don't really think about, right? Like, I'm lucky and fortunate we live on an acreage, but there's a lot of work that comes with that. Like, there's a lot of yard work, and I work a lot and I got young kids, and so my parents luckily take up the bulk of that, which I'm grateful for. But that could easily get to a point where they're not happy about that anymore. And what does that look like, right? Am I willing to pay for my portion? So there's just a lot of things like that you want to flush out in the beginning stages before you commit to buying a property, because buying a property that is in these expensive kind of numbers, 2 million, whatever, you're paying a lot of transfer tax. If it comes to selling that property a few years later, or whenever the time comes, the real estate fees are outrageous. You're going to be paying mortgage penalties and legal fees, right? So yeah, flush out all the details first, and then rolling into the financing conversation, right? So if you put yourself in the parents' shoes, they're probably at the first point in their life where they're probably going to be mortgage free for the most part. And that's a huge piece for someone, right? You work your whole life, you pay your mortgage off for 30, 40 years, and you're finally achieving that goal. But now you're going to be buying a property with your kids or whoever, and you're going to be essentially signing on a new mortgage, which could potentially be a big mortgage, right? So although the parents in many situations actually aren't paying for the mortgage, if they want to be on title of the property, which most of them do, that mortgage is going to show up on their credit bureau, right? Like, they are liable for that mortgage. As much as there's a lot of trust between family and everything else, that's another conversation to have. I mean, we've ran into people that I personally know, and the parents were not cool with that. Like, they did not want to be tied to their kid's mortgage, right? So we've seen people go two different ways. Some of them just back out of it completely because it doesn't make sense for them financially, and other people, the parents in that situation, they could actually opt to be off title, right? So they're not on title, but you could do a co-ownership agreement. So a lot of people think of like the title of the real estate, like that's how you own a piece of it, which is true. But there is a workaround legally, which is just drafted through a co-ownership agreement, which essentially outlines who owns what, and if the property is sold, who gets what, and who's dealing with the estate. It's kind of like it ties into a will, essentially.
Yeah, I can touch on that. I mean, I also live in a situation with, my parents living on my property as well. And, we have certain agreements that we came up with up front around maintenance of the property. Like Derek mentioned, my parents are doing a lot more outdoor work than I would be, and there's certain things that we just spelled out in our agreement up front, and that also came with the potential exit strategy in the event of a divorce, which obviously we don't want to talk about and hope that never happens, but we had to talk about all those types of things as part of an exit strategy if things went sideways for multiple reasons. And having a clear exit strategy, having a lot of these items flushed out before actually making the decision to buy a property together were key. And having a negotiation around exit strategies or things that are just tough to talk about are always better to be done when things are in a good place with the relationship, opposed to the latter where you're fighting and trying to deal with this when you're actually forced to sell. And that's where a co-ownership agreement really protects the good nature of why you're doing it, and making sure you have a clean breakup if you need to.
Yeah, totally. Well, why don't we wait into the financing piece? Let's imagine a scenario where everybody's going on, because we're talking about this co-ownership agreement, but just to sort of reiterate, like, if you're going on title, and I went through this with my own family, I mentioned I helped my parents and my sister buy a place. They were under the understanding, and it's super common for people to think this, like, oh no, I don't need the mortgage. I'm providing the down payment, so I'm just going to go on title. I'm not going to go on the mortgage. Unless we're talking about a fractional mortgage from a super expensive private mortgage, you can't do that with any AAA bank lender, right? If you're going to be on title, you got to be on the mortgage as well, right? So, for people that aren't going the cohabitation route, they can, rationalize themselves, maybe have a different agreement where everyone's going to be still on title. But they need to know that they're going to be on the mortgage. And as Derek mentioned, for parents, anybody who didn't think they needed the mortgage, that's going to affect their ability to borrow down the road. But as long as that's, okay with everybody, then you can certainly proceed that way. But then from the actual financing piece, it's your typical application. Everybody's coming on, everybody's getting their credit check. Everybody, depending on their situation, is providing a certain set of documentation. You're all going into the lawyers to sign. It's a regular process. It's just they're going to be on the mortgage as well. In a perfect world, because we've got different bank partners that can kind of structure mortgages differently, where you can actually have multiple segments on a mortgage. So let's imagine you've got $1 million mortgage. Maybe there's 3 partners on the deal, a parent and 2 siblings. The parent, they put $1 million down. The 2 brothers their siblings need to carry $1 million mortgage. Maybe one, if they're going to split it up into 2 $500,000 segments, in a perfect world, you can have 2 separate mortgages with $500K segments set up, with mortgage payments being withdrawn from each sibling's account. Like, you can achieve that. Depending on the bank that you go to, certain banks won't let you chop it up that way. A lot of our credit union partners are pretty flexible with that scenario. Same with some of our major bank partners. But in a perfect situation, I mean, that's how we try and structure this. Obviously, the application itself and where interest rates are tend to sort of dictate where that mortgage application goes. But, if you're thinking about maybe entering in this type of, purchase and mortgage structure with family, there is a way to set it up so that you can kind of, at least mentally piece off, okay, I see there's $1 million mortgage in here, but my obligation is only 400,000. I don't want to be looking at this $1 million mortgage statement every time I log into my online banking, although it probably still would be there in total. But you can actually segment it so you can actually see your own, portion, and then you can make payments based on yours.
That's a great point, and that comes up a lot as a request to be able to structure it that way and be able to manage, your personal allocation of the debt. It is important to note that just some lenders don't actually allow that, or just don't have the technology or mechanism to be able to divide it like that. So that comes down to, just having that awareness, working with a group like us, being able to articulate, what options are going to be available to you based on the lender. And that's just, again, back to, is it always about rate when choosing a lender? Sometimes it might be, in a situation like this, just better to have flexibility and better management of the debt going forward.
Totally. I mean, we've kind of hit just about everything I can think of. I mean, just to sort of sum it all up, I mean, the conversations we're having around multi-generational buying are only increasing, right? And the big reason is affordability, especially in the detached marketplace, detached home marketplace. So, the key takeaways are just, have the tough conversations up front, engage with a lawyer, try and get something drafted. Handshake agreements, can sometimes sour if things go south, and just make sure you're employing the right mortgage professional to kind of help you sort of structure this in the best possible way so everyone can make sense of this and wrap their heads around it. I'm not sure if you had any other tidbits you wanted to chuck in there, Dean, before we sign off.
No, I think you covered it all. I mean, that's great. And yeah, ultimately going down this path, you're going to require a lot of good professional advice, and don't hesitate to reach out, and we can, direct you to the right partners, especially around co-ownership agreements, and looking at maybe fleshing out some of those items as a draft of an agreement before even making an offer on a property. So, whatever it is, we certainly have you covered in all departments when it comes to multi-generational housing or living as you go forward.
Yeah, and super, super common. Three of us on the podcast, three of us all with this exact structure happening in our families. So I think we'll leave it for there, and hope you enjoy the podcast. If you guys, as always, have any questions, comments, maybe ideas for different topics you'd like to learn about, just drop us a line, email, message, DM, and we're happy to tackle it.